Bloomberg Audio Studios.
Podcasts, radio, news.
Hello, it's Merryn Somerset Webb here. This week, our guest is John Warren, co-founder of Tellworth Investments and manager of the TM Tellworth UK Select Fund. He's got 18 years of investment experience, but that's not why we asked him on. He runs an absolute return fund, which is something that John and I find particularly interesting. So we talk about the way that works. But before we get to that very exciting conversation, as we always do, we start with what I think most of you consider to be the best part of the show. A conversation with Money Distilled newsletter author John Stepek. John, let's talk. And I'll tell you what, let's talk about your absolutely favorite subject. New high after new high after new high. Who wouldn't want to hold the FTSE 100?
Exactly. And we've got another new high today as we're recording.
So exciting.
In fact, actually, I may need to double check this, but Simon French over at Panmure Gordon the other day tweeted out to me saying that if the FTSE manages to close at a new record high 12 times in a row within a month, this will be like the first time that's happened since, I don't know, years and years and years. So that's very exciting. I'll be looking out for that.
What's making it happen? What's making it happen, John?
The fact that fund managers are essentially herd animals and they've seen something hit a new high and they're suddenly like, oh my God, there's a bandwagon that's moving.
John, I have to interrupt you briefly. We don't call them herd animals. We don't call them like
what we
call them is momentum investors.
Yep.
Well, we had this conversation before. Momentum investors.
That's the politically correct term.
Okay. So finally, global investors have noticed that the UK is cheap, that Brexit has not been the end of the world, and that there are some really great companies in the UK and they can buy them for significantly less than they can buy companies elsewhere. In fact, even after all these new highs, I think the UK is still at a 19% discount to global peers, right?
It's still cheap. And it is interesting because I had a quick look. So my go-to for all of these things is the Bank of America Global Fund Manager Survey. It's actually really good sentiment indicator. And it comes out every month. So I look back at the January one for this year. And the UK's been at the bottom for ages. And the January one, it was rock bottom. Global fund managers said that they were more underweight the UK relative to history than any other asset class. And that's like 21 different asset classes. So big underweight, as in they don't like it compared to the benchmark. And then I looked at the same one for last month, and it's basically been the same, February, March, April. May, that's actually changed. They've actually moved some money into UK stocks, and they're now ever so slightly just above average compared to the last 20 years. So that's been there has been a real sentiment shift in a fairly short period of time, and it has pretty much coincided with, the FTSE hitting a new record high. And to be fair, also the kind of move to value, because people have started to get a bit started to think that actually interest rates are going to be higher for longer. So maybe the growth stuff isn't necessarily the thing to stick with anymore. But I do think most of it's actually momentum as well. You just spot something moving and you don't want to be left behind.
John, he respects nobody as much as he respects fund managers. He's all over them. Absolutely. Right. Listen, so we're getting note after note after note from various banks, brokers, etc., telling us what we've been telling you for a long time now, that the UK is cheap and you should buy it. But I do want to point you to one in particular, which is from our podcast regular, James Ferguson. And he has written a note, and I will do a little summary of it and stick it on John's Money Distilled newsletter for you at some point. And his is called Union Jack in the Box, right? This is not an ordinary bull market. This is a British bull market, right? And his argument is that, is slightly different to our argument, to be honest. It is that inflation is absolutely out of the picture. He says that as far as he can see, there is very little inflationary pressure left. There's an 18-month contraction in nominal money supply, 2-year stagnation of GDP. There is absolutely no excuse for base rates to be knocking around at the 16-year high of 5.25%. So he thinks that once inflation is out of the picture, and he thinks that everybody will realize that soon, rates have, and I'm quoting here, ample scope to be cut a long way, alleviating the pressure on both indebted retail and commercial property owners, stimulating productive bank growth, and all without threatening a re-acceleration in prices and decloses. No wonder the FTSE has just broken out to a new 6-year high. And so he is looking not just at the cheapness, but at the fact that he expects interest rates to fall quite fast soon. And I did ask him about that, and he said there's just no reason for them to stay high. I still feel, as I think you do, John, that central bankers might be taking the opportunity to try and normalize the idea that rates should knock around 4%, not 1%, and therefore the fall is going to be slightly slower than a lot of other people think.
I mean, I've got a huge amount of respect for James because he's one of the few people that we know that explicitly got the 2008 crisis right and was warning about deflation even after all the money printing, so he knows what he's talking about. Despite all that, I still struggle to see that happening. And it also depends. I mean, it depends partly what he means by a fast drop in interest rates. I've read some of the note, but not the whole thing. And, if he means it'll get to 4 quicker than everyone's expecting, then that's one thing. But I'm on the camp that says that rates don't go below 3% effectively ever again, as in for a very long time. So I'd be curious to know a bit more about exactly what he's expecting. All
right, I'll give him a call. We'll stick it in the newsletter. But he keeps using the word substantially. The MPC now has a very clear path to cut rates substantially, rejuvenate bank lending, etc., etc. His only concern, of course, is the incoming Labour government and the Bank of England. Will they work together and keep policy relatively tight, unleashing the private sector to go for growth, or will they not? I think we can probably guess the answer to that. But we'll come back to that maybe in 6 months or so. Right, John, anything else you want to say about this wonderful bull market?
No, I think everyone should just sit back and enjoy it.
Now, before we get on to the conversation with John, I want to point you to something we talk about during it that we didn't define and we should have. We talk about Sonia, and he talks about wanting to outperform Sonia. And a lot of you are going to be looking at that and you're going to be thinking, well, what on earth is Sonia? And what it is an interest rate benchmark. It's the average price that banks pay to borrow sterling from each other overnight. So it's just a standard, straightforward measure of basic interest rates. And if you are going to attempt to outperform that, you're just going to be making more than you would in cash, which seems like a good way to run a fund. Right, John?
It's the replacement to LIBOR, because people might have heard of LIBOR.
Okay. Good point. Right, we'll come back to this in our conversation after our conversation with John. Welcome to Merryn Talks Money, a podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. Here's my conversation with John Warren, who launched Tellworth Investments in October 2017. Before that, he worked at Cazenove Capital, UBS, and Investec. We begin the conversation with John explaining why the fund he runs, TM Tellworth UK Select, is different to a standard fund.
The Tellworth fund that I run, the UK Select Fund, is an absolute return fund. So what we are trying to achieve is very consistent, low volatile returns for our investors. And we achieve that by being both long and short shares. We do that by being neutral to the market. So we're not trying to take a big directional bet on the market and basically be stock pickers. So we want to buy stocks that are going up and be short of stocks that are going down and make consistent returns with a very low volatility. And importantly as well, not be correlated to the direction of the market or changes in economic conditions or interest rate cycles, which is clearly a big area for debate at the moment. And really just, we are targeting 8 to 10% returns a year on a consistent basis. That's what we're trying to achieve for our investors.
Okay, that's an extraordinary thing, 8 to 10% a year. Now, when you say absolute return, of course, we're all immediately thrilled, because one of our big gripes, me and John, one of our big gripes for the fund management industry as a whole is benchmarking, is the idea that returns are always relative to something, the returns of something else. You're never judging yourself in absolute returns. How much money have you actually made for people year by year by year? It's about, well, I outperformed this benchmark by 0.5%, or I outperformed that benchmark by 1.5%, or whatever it is. And we always look at it and we think, well, hang on a tick. If you are judging yourself relative to something, it's got to be quite hard to outperform it over the long term, because you're always looking at it and going, oh God, I'm scared I'm going to underperform it. Therefore, you do end up investing in a way that is much closer to the benchmark you're tracking, then you should, right? So we're always
Absolutely.
looking at active shares, the extent to which a fund is different from the index it tracks. And so often you're still looking at fairly low percentages of funds being genuinely different to their benchmarks. And I always think that maybe one of the great mistakes that this industry has ever made is being relative.
I'd agree. And what are people trying to achieve with their savings, and what are savings products trying to do and investment products trying to do? Well, you're trying to grow your wealth over time. That's surely what everyone is trying to achieve. It's certainly what I try and achieve with my personal wealth and with my investors' funds in the fund. Clearly, if you are long only, there is always some element of direction of the underlying market you're investing in that's going to dominate returns. So it's very hard to make absolute returns if the market has a big bear crash, for example. What we do, though, is by making sure that we're not taking that market risk by having positions both sides. It means that we are generally should be expected to make returns irrespective of what's going on in the broader economy and the broader market. So we benchmark to cash, so we have to outperform cash. So we use Sonia for that. So clearly that wasn't much of a challenge for many years. It's more of a challenge now, but we benchmark against that. So we expect to make a return in excess of the cash return. And like I say, targeting 8 to 10.
Do you think all fund managers should do that? I mean, I always think that it would be polite of fund managers to tell us they're going to make us cash +3, for example.
I think it would be a nice thing to hope, and I think most people judge their wealth managers with that. If you're looking at an overall portfolio, I think it's quite hard, though, if you're investing in a niche specialist fund, to expect to be able to beat the direction of that fund. But I guess a lot of it comes down to your time horizon, doesn't it? And unfortunately, many people now look at quarterly performance or half-yearly performance. If you're looking over a 5 to 10 year view, then I would think that's a perfectly acceptable thing to expect to ask.
Yeah. I mean, anyone charging you 1.5% or 1% or even 80 basis points a year for their special skill should be able to give you cash +3 percentage points over a 5-year period.
I think once you're getting into longer term periods, that's an absolutely fair requirement.
Okay, good. We've established new rules for the fund management industry. Anyone who can find a reason to disagree with us, hate mail to John, please.
I know. I expect some colleagues will be getting in touch shortly.
They always do. Okay, so here we are. You invest in the UK market. I know that for you, it's not about direction of the market itself, because as you just said, you're short and you're long and you're trying to be neutral. But nonetheless, it feels like, I'm tentative here because, you can have the wrong feelings, but it feels like something is changing in the UK market. People are beginning to get interested. The big banks, the UBSs, etc., the brokers are beginning to change their view and suddenly say, well, actually, it's not the market we hate most in the world. It's one of our favorite markets because it's cheap and it's interesting. There's a sense there might be some foreign buyers coming in. We're seeing new highs in the FTSE 100 over and over, and the other areas doing well too. Might even be some interest in mid and small caps coming through. Are you buying it, that there's a turn here?
It definitely feels like there has been a change in the sentiment into the UK market. I think that's come from a few reasons, one of which is just performance. Unfortunately, the market is a momentum-chasing market in so many ways now, and the performance that the market has had is attracting some more flows of funds. I think one of the areas which has been much talked about on this podcast is the lack of equity inflows into the UK market that has been ongoing for a long, long time. Interestingly, though, overseas investors have actually been net buyers of the UK for a period now. And the very noticeable factor as well has been the increase in M&A. So we always thought one of the big catalysts for the UK market sentiment change would be a FTSE 100 bid. We've had that with the approach for Anglos from BHP. Clearly, that hasn't actually come to sort of any formal agreement yet. But just the fact that a business of that size is attracting M&A, and we've seen a lot of it further down the market caps as well. We invest a lot in the mid-cap part of the market as well as the large-cap part of the market, and we've seen lots of bid interest. So the trade buyers coming in, seeing value in these companies at meaningful premiums, and the overall, the valuation of the UK market is very, very attractive on both an absolute, and I hate to say it, Merryn, but a relative basis as well. So when you're looking at the UK market relative to particularly the US, I think we're at a second percentile. So, a 2 in 100 year valuation cheapness. against the US market.
We're happy to look at relative after we've already looked at absolute. So if it's cheap in absolute terms, then it's also extremely cheap in relative terms. Then I think that's excellent news. But you said that foreign buyers have been net buyers for a little bit of time now, but domestic buyers consistently are not. And one of the other things we always say on this podcast to our listeners, particularly those who are UK-based investors, if you don't buy these stocks, somebody else will. And we see that in the M&A, right? What is it, do you think, that might make UK investors start buying again? Will they dive into this momentum, or do they need something like the Brit ISA or something like that to make them stop with the domestic self-loathing, which we see not just in investment, right? We see that across the board. What might make them return to us?
Well, like I say, unfortunately, some of it is FOMO. So some of it is just needs to be the fear of missing out. We also have some long-only funds at Tellworth, and one of my colleagues, Paul Marriage, was seeing an investor only the other week, and that investor said, well, I'm very happy to miss the first 25% of a move. So sometimes that's the way that people want to move, and unfortunately, people are trend followers, and that may well be the case that we need that performance. I think changes from pension reforms, from the Brit ISA, all of these things are great sentiment helpers. And actually, I think the other point that we probably need to see is just people actually starting to look at value again and understanding what valuations mean in investing. The market has been very driven by momentum, earnings upgrades, and almost wanting to buy growth at any cost. But at some point, valuation does matter. And that's what corporates are telling you. That's why they're buying these companies. And as we see interest rates hopefully starting to move down in the UK, it seems like the UK economy is slightly different now from the US. It's quite possible we don't see rate cuts in the US, but we probably will see them in the UK. We think we probably get one in June. And that may well just bring people back to the UK a little bit as well.
I think we'll get one in June, even with those rather nice GDP numbers we had the other day, showing that actually things aren't so bad and the economy is barreling along rather pleasantly.
I think so. And the signalling from the MPC, I thought last week, was probably that we do still get one in June. I don't think it matters too much whether we get one in June or slightly later in the year. The main thing is that I think there's a very clear signalling now in the UK market that rates have peaked, and the next move will be downwards. And when you look at the correlations of the FTSE 250, particularly to rate expectations, it's very strong. So if we start, as those rate expectations come down, we see the FTSE 250 starting to perform really quite strongly. So I think that bodes quite well for the domestic parts of the market, and maybe a broadening out of this rally that we've seen, which has actually been pretty narrow so far. It's been very driven by banks, miners and oils, and we would see that broadening out more into the FTSE 250 as those expectations of rate cuts start getting priced into the market. Okay.
So let's talk about where you're actually invested then. Now, you say that you're market neutral and you're sector neutral, right? You have no specific adherence to any favourite sectors, anything like that. So you're pure stock pickers. So where are you finding the value? What is interesting?
We do think that banks have been interesting for a while. We were a bit early into it, into last year, but we still think NatWest is a fantastic business. It's got great opportunities. It's now growing its tangible net asset value. You've got the structural hedge, which will have some meaningful impact on the P&L this year.
Stop. Go back. Structural hedge.
So this is basically the way banks manage their balance sheets, so how they fund themselves. And that means that as interest rate expectations change and come down, that hedge starts paying them money, in simple terms. So we think at NatWest it's about £300 million of profit a year generated from essentially the balance sheet, where they have a fixed leg and a variable leg on their balance sheet. It's been a big negative impact on the P&L while rates go up, and it becomes supportive to the P&L as rates fall.
Okay, so if rates don't fall...
If rates don't fall, it will have a net zero benefit to the, it won't impact. But as time moves on, you have some of that old leg of the P&L, which was funded at very low rates, that starts to roll off. So even if rates don't fall, just the passage of time benefits the balance sheet as well.
So NatWest, other banks?
Yeah, we are also... think that One Savings Bank is interesting. This is a buy-to-let lender. It's had its issues. It's definitely had its issues with with expectations management, its interest margin its net interest margin has been under some pressure. But these are just very, very cheap equities now. So one savings bank is trading on a PE of less than 5 times. It has it will be returning some cash through dividends as well. And so we just think there's just incredible value. And we have to be patient. I think it's very important to say that sometimes when we tell people that we're long short investors, they think hedge funds, trading, all you're doing is taking short-term bets. No, we're very happy to take long-term views on these businesses. And as long as we have that balance within the portfolio, we can take that long-term view.
Well, I accept that you're not looking at sectors. Are there any other groups of stocks that feature prominently in their portfolio?
Yes, so airlines and tour operators is a part of the portfolio where we're quite encouraged. We own Jet2, we own EasyJet, we also own Ryanair. We think that's a sector that's in really good health at the moment. It's one thing that it seems that the UK consumer is not prepared to give up on is their summer holiday. And until this weekend, you can certainly see why with the weather we've had so far. One of the areas we like to look at a lot when we're analysing businesses and industries is the supply side. And the supply side of the package holiday industry has changed a lot. We've seen some quite big exits. Obviously, Thomas Cook going bankrupt a few years ago has made big changes to that industry. But also, the other area of supply side is in the supply of planes. And it's been well publicised that Boeing and Airbus as well now are having some problems delivering new planes. That means that a lot of these airlines have some real pricing power now because capacity is not coming back into the sector as quickly as people might have expected, and therefore they're getting good pricing. So unfortunately, although everyone is going on holiday, it's costing you all a bit more this year, but that is very good for the profits of the airline companies. Fuel prices have also come down as well. So we like the dynamics of that industry. Again, the valuations there are really attractive. Jet2, 7.5 times earnings, I think, for the forecast. Its longer term average PE has been 12. This is a business that's grown revenues at 20% over the last decade and profits at 30, trading on 7.5 times earnings. So, we really see there's both good drivers for the P&L and also a very attractive valuation metrics across the airline sector.
There's no sense at all that people are translating their intense anxiety about climate change into their summer holiday plans, is there?
It definitely isn't impacting consumer behaviour at all.
Is there any long-term risk to holiday companies and airline companies around, say, regulation on the extent to which one can fly or not fly? Constantly seeing stories in the newspapers about how it won't be long before we're all limited to 4 long-haul flights in a lifetime.
Let's hope not. But I guess there's always longer term risks for companies. The one thing I would say is that we're paying 7.5 times earnings. So it's a bit like when you look back at the tobacco companies. Clearly, everyone has taken the view that tobacco is not good for us, not good for anyone, and they've been heavily regulated. But when you're paying very low valuations for these types of shares, the shares can still do a really good job for you, and that's what we would see.
And also, if you're one of the incumbents, you're set pretty fair, aren't you?
Well, exactly, and that's the thing. It stops new entrants coming in and wanting to try and compete away those attractive margins that you're seeing.
And is that also the case in energy? Because no one's going to go out now and sort of set up a new oil company, are they?
No, and again, oil isn't a sector that we play a lot in. A bit like the miners, what we're trying to do is, as stock pickers, what we want to be able to do is analyse the actual company and value it like that. What we don't want to have to do is make these big macro calls. By being market neutral and factor neutral, what it means is that we don't have to spend our time worrying about what the next GDP figure is or what the next interest rate cut is. What we can do is have a balanced portfolio in the way that you have with an oil company. Clearly, the most important thing for how that share price performs is what's happening with the oil price. And frankly, we don't really have a clue. So we'd rather not make that decision.
All the evidence tells us that nobody has a clue. You wouldn't be alone there. You'd only be alone in admitting it.
Exactly.
So what have you added recently? What's come out recently and what's come in recently?
I would say the most recent addition would be a business called Dowlais, actually, which is another stock that very much falls into that value bucket. So Dowlais was a spin-out from Melrose. It's an automotive supplier, so not particularly trendy, I guess, in that, and maybe if we're getting into ESG world, we can talk about that. But they are a leading producer of drivetrains. So these are the parts of that actually change the engines through the wheel. So you have a drivetrain that comes down the middle of the car and that puts the power from the engine into the wheel. They're the leading provider of that in the world, pretty much. They have some good products for electric vehicles as well. But this is a business that has really just been completely lost in the UK mid-cap space. Like I say, it's spun out of Melrose, so the shares got put into the hands of Melrose shareholders, who I don't think really wanted to hold a UK mid-cap auto supplier. So that's been they've been sold heavily, and now these shares are trading on a P of 5 times with a decent balance sheet in a industry that they are growing revenues, growing profits. And we just think that's just too cheap. What we've been watching there we've been watching the shareholder register and how that's evolved, and we've seen a huge churn in that, and we think that that's pretty much at the end. And on that valuation, we've decided that was an interesting time to come into the stock.
It does seem ridiculously cheap, doesn't it? Are you seeing a lot of that kind of price in the smaller mid-cap sectors at the moment, and particularly in mid-caps?
In mid-caps, I mean, there are a lot of stocks. I mean, we did some analysis at the start of the year, and I'm afraid we haven't updated it since, but we looked at the FTSE 250. So in the FTSE 250, there's 100, or at the start of the year, obviously there's a few less now, but there are 167 trading companies. So if you take out the investment trusts, etc., 167. Now, a third of those were on a free cash flow yield greater than 13%. There's really, really strong cash flows, and the market's just ignoring them. People often talk, don't they, that profits for show and cash is the king. And if you've got that genuine cash flow coming through in these companies, it's very hard to doubt that those valuation metrics are for real. So, we see a lot of great opportunities in the mid-cap space, but also in the FTSE 100 as well. This, like as we've been talking about, the banks and the airlines are still very, very cheap.
Yeah, and Marks and Spencer's, is that still one of your top holdings?
Yes, I think Marks.
I feel like in my career now, I've seen Marks and Spencer's go round in so many circles, it's getting ridiculous. And so many times when people have looked at Marks and Spencer's and gone, "Oh my goodness, it's so cheap, it's so cheap, it's so cheap," and here we are, still cheap.
I'm not quite sure myself as well how many times I've bought into a new Marks and Spencer's recovery plan, but this one actually seems to be working. So yes, it's Marks and Spencer's is actually the biggest position in the fund at the moment, single stock position. We think it's actually the transition plan is working really well. The things we have looked at, particularly given us encouragement, is the full price mix. So that's improved from being in the 60% to 80%. So that's how many of their sales they're managing to sell at full price rather than having to discount.
Interesting. What's normal in the retail sector?
The best players in the industry will achieve 90. So Next and Inditex will be in the 90s. So there's still a bit further to go. And we would hope them to get there, but 60 was pretty awful. Again, when looking at the supply side, the one thing that's there's been quite a lot of exit in clothing in the UK market. There's been lots of closures. Probably the most important one for the sector was Debenhams closing. They were the most disruptive in terms of that discounting on the high street. So that's probably helped them, but also better ranging. But interestingly, even with that move in full price sales, the gross margin hasn't really improved yet. Part of that was clearly cost inflation, but also that implies to us they're becoming much more cost competitive, which is clearly important in the economy at the moment where consumers have been a little bit under pressure. So we think that's really interesting. The food business has always been good. There's a big opportunity for them in homewares and beauty products where they don't push anywhere near their weight, and the balance sheet's much better as well. So we really like Marks and Spencer's, and as I say, it's the biggest long position in the fund at the moment.
Interesting. And the other two that I'm quite interested in your top holdings are the London Stock Exchange. Tell us about that a bit.
London Stock Exchange is a really interesting business. We think it's one where there is lots of M&A opportunity for them. We've seen consolidation in that space. It's also transformed its profitability a lot into data products as well. So the FTSE and the Russell indexes, and as a small business, when we know how much we have to pay for these products, and there's definitely been strong inflation in there. It's been a good performer for us, and it's actually been one we have been reducing because we do see that valuation as being pretty full now. So.
Okay, so you reduce on a valuation basis. Is that how the shorts work as well? So you're shorts to make you market neutral. You've got longs and you've got shorts. The shorts, are they companies that you think are lousy companies, or are they companies that you think are just a little too pricey, even if they're high quality? How does that work?
It could be a combination of both. So generally, we have about 40 positions on both sides. So we'll have about 40 longs and about 40 shorts. So clearly, trying to find 40 companies in the UK market that we think are going to go bust is probably unlikely. So we can't just be short bad businesses. Also, as I said, we want to be factor neutral as well. So if we're looking at the quality factor, we have to be short. If we're long quality businesses, we need to be short some quality businesses as well. So we have to accept the fact that we're going to have to be short businesses that we think are really good businesses where we just don't think the valuations are right, or we think there's some risk out there. It's a tricky skill. Not many fund managers have done it successfully over the years, because you really need to have that ability to separate businesses and share prices and accept the fact that you can be a good business, but you can be trading at the wrong valuation. And unfortunately, we are a UK only fund here. We do a little bit in Ireland and a very small amount in Europe, but that means unfortunately we can't be short lots of the very highly overvalued businesses in the US.
So it's pretty brutal stuff then, the way that you work. And there's an ordinary fund manager that starts to meander around the place finding something kind of like, but pretty much every time you find something that you like, you also have to find something you're prepared to short.
Exactly, and
it's brutal.
It is brutal, and it's hard work, and it's we need lots of ideas, but also sometimes it's accepting the fact that some of the shorts will not make you absolute returns. So, at the moment, over the last month or two, it's been pretty hard to make absolute returns on your shorts because the market is going up very strongly. But as long as we can pick longs that go up by more than our shorts, then clearly we can make good returns for our investors.
Okay, but it's harder for you when the market is rising. So let's say that we're right, you and I, because we're bound to be right about the UK market being in recovery and the momentum leading to more momentum, because at heart, as John and I discussed last week, all fund managers are really momentum managers. It doesn't matter what they tell you. Oh, I'm value, oh, I'm quality, oh, I'm this, I'm that. Nah, you're all momentum, right? So as it gets going, it'll get going more. The market goes up and it becomes hard for you. You're harder for you to consistently outperform other funds, although obviously we don't believe in relative. But for the moment, let's talk about your performance relative to other funds. As the market recovers, that becomes more difficult for you, not easier, surely, if everything's going up.
It makes it more difficult to make absolute returns on our short book. That's correct. But clearly what we need to do is make sure that our longs are going up by more than our shorts. And when the market is performing very strongly, we are not going to make you the same amount of money as a long-only fund. But what we will do is protect your capital much better and hopefully make you returns when the market is falling. So it is that we don't sell this fund as a UK equity fund. So most people that invest in this fund are not buying it because they think the UK equity market is going up. They might be buying it because they think the UK equity market is going down, and therefore they want the ability to have that absolute return. But what they're saying is this plays a part in my portfolio of where we can get that consistency of return and uncorrelated returns. So it's not correlated to equity markets or bond markets, and it's producing that type of return stream. But yes, I mean, shorts is always hard. Most of the market is always positive. Most analysts are always positive on stocks. So you have to be prepared to be cynical. You have to be prepared to go against what most people are telling you about that company, and usually the company managements as well, because clearly company management teams always want to tell you how great things are. They don't want to highlight the bad bits. So that's definitely a skill that you have to develop for running a strategy like this.
Strategically speaking, for a retail investor, if you are thinking about how to construct your portfolio, and perhaps you have a fairly big passive component to your portfolio, this is the kind of active fund that it makes sense to hold alongside a passive portfolio. Does that make sense?
Absolutely. I think these funds are not very well understood by investors. I think sometimes people are scared of them. I think sometimes the regulator's scared of them as well, to be honest with you, with the risk ratings we get sometimes on these funds, because we do short companies and we use CFDs in the fund. So that makes the regulator sort of a bit concerned about this product and can put quite high risk ratings. But actually, when you look at the return profiles, these are incredibly low risk funds. And we spend a lot of time as fund managers managing the risk of this product to make sure that we're not taking market risk, that we're not taking interest rate risk. We're not taking domestic risk as well. So we don't want to be sort of just long the domestic economy as well. So I think they hold they can play a really important part in an overall investor's portfolio for that sort of ballast of something that's trying to achieve. And when most people think, what's an acceptable return on my investments over the years? As we say, long-term returns, people usually assume a sort of 5 or 6. So if we can generate 8 or 10 in any market environment, we think that's a really attractive income stream.
I think we'd all say that.
Of course.
Do you worry that passive is getting a little too much? That, in the beginning of the drive towards passive, we were all rather thrilled at the idea that you could get a perfectly adequate long-term investment at an incredibly low cost. But now that more and more of the assets under management are passively managed, do you think that affects the market or causes any long-term problems?
I think it does. And I think that the industry needs to have a look at this at some point and see where is the tipping point that we're not getting proper price discovery. And I think that is always a risk that passive is, you were just mentioning about how every investor is a momentum investor. Well, passive is the ultimate momentum. And I think it brings real risk. And the idea that, I'm passive to the market, therefore I'm reducing risk, just isn't the case. And particularly not when we're at stages right now where the Mag 7, for example, is taking up so much of these global indices that you're actually taking a lot of risk that you probably don't realise you're taking by being passive. And as I say, one of the reasons why I think there's the valuation argument is not being looked at and the valuation attractions of certain markets and certain stocks isn't being taken into account is because the passives aren't looking at that. The passives just look at a weight and buy it. So it definitely brings risk. I think it was highlighted very strongly last year with Silicon Valley Bank. I read some statistics that there was one quite vocal short in that stock, but no one listened to him. But I think 7 out of the top 10 shareholders were all passive investors. And as they said, that if you look for the problems, you could have seen them, but passive investors aren't looking for problems. And that means you get very bad price discovery, and that means that you get some big issues coming into markets.
You have a price discovery problem, potentially also a governance problem.
Absolutely.
Oh, that's depressing. When you look at it, sorry, you carry on.
No, I was going to say, well, look, I do think there's a cyclical element to these things. And clearly the market has moved strongly into passives, and that's been partly driven by a regulator as well, who's very focused on cost, not just on investment outcomes. So I think a more balanced approach on that will help as well. And maybe it needs a bit of a bear market or a bit of a correction in some of these really big stocks and these really big the areas of crowding in the market need to have a correction that will then shake out and make people understand that cheapness of the investment product, just so the cost that it's investing is not the only thing you should be solving for in portfolios.
When you look around the world, I know you're very focused on the UK, but I'm sure you also have an eye for the rest of the world. Are there any other markets that you find interesting from a valuation point of view? I'm guessing you wouldn't touch the US with a barge pole.
No, I wouldn't. I mean, the Cape PE of the US market is 33 times. So the Cape PE is the long-term PE, so the 10-year PE. That's at 33 times, which I think has only been above that twice in its history. So no, I think the US looks like it's valued for perfection to me, with margins pretty much at peaks. So I think there's a lot of risk in the US market. I do think China might be getting interesting again. I mean, a very uneducated view, so please, I'm a UK stock specialist, so please don't take my view on global markets.
We're interested in your instincts. We're interested in your instincts.
So I think that China has is starting to look interesting again, and maybe a few more of the emerging markets could be. Japan has clearly been had a good run. I think that Japan is maybe a good indication of what could happen in the UK. The valuations got to extreme levels and it rallied quite hard, and I think that we could be entering a period for the UK market a little bit like the rally we've seen in Japan over the last 18 months. Or so.
I'm not sure the Japanese be thrilled to be lumped in with emerging markets.
Sorry, I was thinking China in that sense, but you're correct to pull me up on that. So thank you.
Okay, now the final question: if I were to not allow you to hold any small caps, any mid caps, any large caps, in fact, absolutely no equities at all, but for a 10-year period, you had to either hold Bitcoin or gold and nothing else, which would it be?
I listened to this podcast, so I know this question was coming. And I really wanted to try and find a reason why I could say Bitcoin, because no one else seems to say Bitcoin. But I can't, unfortunately. So I can't find a compelling reason to own Bitcoin. Anything that has the volatility that it has, and being an investor that looks at volatility, that can't be any store of value. So unfortunately, I'm going to have to go with the huge consensus and say gold.
I don't think it's disappointing.
Well, I know, but I like to think as a long short investor, we like being contrarian at times. So I wanted to try and find that, but unfortunately, I couldn't find a good reason.
Have you got any gold?
Yes, in my personal investments, I have a bit of exposure to gold. I also have a little bit of exposure to Bitcoin as well. I must admit. So, but that is very much as a trading position, not as a long-term investment.
Okay, well, that is interesting in itself. This is the first time we have had anybody on the podcast who has admitted to being a Bitcoin trader on the side. So you've given us something.
Yes, exactly.
Thank you so much. Really enjoyed talking to you.
Thanks very much, Merryn.
John, I think that John, too many Johns. I think that John is really interesting. And I think it's also worth saying before we really get into talking about what he said, is that the performance of his fund has been excellent. It's a very small fund, and the small funds are easier to make outperform than big funds. I get that. But nonetheless, last 5 years, he's up 54%, FTSE 100 over that time, 33%. But still, rising fast now, right?
Yep.
So he's massively outperformed the index he would use, which would be the Investment Association Targeted Absolute Return Index, I think, although obviously, as we discussed in that conversation, he's not interested in the index. He's interested in making slightly more, or hopefully rather a lot more than you would on cash.
Yeah, and I thought it was really interesting. I think the listeners will have enjoyed the fact that this has actually been quite a good tippy one. There's lots of talk about individual companies. I
know it's not easy to get fund managers to do that. I'm always trying to get them to, come on, give us your top holdings, tell us your top tip, what would you hold for 10 years or whatever. But mostly I think, the compliance environment has changed. And in the old days, it was quite easy to get fund managers just to sort of pour out a list of tips. But now they're rather more circumspect about it. Well, most of them are. John's been the exception to the rule there. Thank you, John.
It's daft because their top 10 holdings obviously are public information, so they should be able to come on and feel free to talk enthusiastically about them.
Yeah, and explain why they hold them. But mostly, as we say, it's quite hard to get them to do, isn't it?
I did think the stuff about absolute return was really interesting, because being able to go short is actually one of the few ways that active managers can properly differentiate themselves from passive. You can't do that with a passive fund. And even the most kind of active retail investor is going to struggle to an extent to run, unless you're really kind of doing a lot of CFDs and spread bet and things like that, you're going to struggle to run a long short portfolio the way a kind of fund manager can. So it's interesting actually that sector is, I know absolute return got a bad name for itself because the returns were absolutely awful, as opposed to actually beating interest rates, about a decade ago.
It's true. They were awful, and it was all a bit awkward back then. But the truth is that it's still a more honest way to run money. And even if you are a long only manager, it's still more honest, I think, to compare yourself to what we would get if we stuck our money in the bank, and to work to outperform inflation rather than to outperform other fund managers, because that's really all we care about, you and I, right? And our listeners, I think, too. They're not interested in having your money in the best performing fund manager. That would be nice. Of course, what we're interested in is protecting our capital, protecting the purchasing power of our capital, and hopefully increasing the purchasing power of our capital. But first of all, mainly the thing that we want is, don't reduce the value of our capital. I'm saving this up for my retirement. I need my money to be a time machine. I need it to be able to buy the same stuff in the future, or more than it does now, not less. So let's work on that basis. And so I do think that even though there have been periods in the past when this has not worked, and periods in the past when people have treated absolute return as hedge fund as opposed to cautious absolute return, it's still an honest and valuable way of running money.
Yeah, you're right. Making a consistent real return is what you really want from your money. And obviously, you do eventually get to a point, hopefully, where actually capital preservation is more important than capital growth. So there's also, I mean, that's in a way another conversation as well. But
it's one of those things, isn't it? People, if you they have these sort of risk things when you sign up to a wealth manager or a fund, etc. Which risk level are you? And if you're at the top risk level, you're supposed to accept that it's possible that you might lose a lot of your money. But no one signing up to those things really believes that, do they? I mean, no one really signing up to risk level 5 thinks to himself, I might lose 40% of my money, and I'm fine with that.
Exactly.
Nobody thinks that.
Yeah, I mean, the risk question is daft. I mean, where you're invested as an overall asset allocation level should broadly be based on your time horizon and not on any imaginary capacity for temporary losses, because that's the other thing. They're not actually asking you, are you okay with losing 40% of your money? They're asking, are you okay if the wee spreadsheet we send you every month sometimes says you've lost 40% of your money, but at the end of that it won't be 40%, because the whole point of taking the maximum risk is that it's a bumpier ride along the way, but you make more by the end of the 20 years or whatever it is. So I think that that whole concept of risk is very, very confused. And I mean, I appreciate it's a confusing subject, but that's the kind of thing that people, IFAs and things like that should be explained to people.
So really, instead of just ticking a form like that, you should have a full psychiatric assessment.
Absolutely.
To make sure that you're the kind of person who can deal with the stress of that kind of fluctuation.
Exactly. You can get your Prozac alongside your asset allocation.
I mean, we could add a whole new layer of complicated compliance to investing by insisting that everyone has some kind of analysis done before they're allowed to tick 5.
Yep, I'm sure they. Actually, I'm thinking about it. The compliance industry would thank you for that. I'm not sure about the finance industry, but.
Anyway, sorry, I've gone off topic, John. I've gone off topic. Tell me what else you found interesting about this conversation.
I thought it was all very interesting.
Well, you liked it because he's pro the UK market, just like we are, and he thinks the turn is in, and he's talking about trade buyers seeing value at really quite impressive premiums, and he's saying, this is attractive on absolute levels, and although he was a bit embarrassed to say the word relative, he did say on a relative basis as well. So, he's very pro all the things that we're pro, so we like that.
It's massive confirmation bias, basically.
I know, love that.
Actually, and the other thing I thought was interesting was the shorting element. This idea that he's got and I must admit, there was a part of me that was kind of that was struggling with that a bit, and that I'm thinking, wait a minute, so every time you buy a stock, you're going to have to find one to short, even if you don't think, there are any that are great shorting candidates. But I guess that's how you make it market neutral.
Yeah, well, you own the really good ones, and even if there aren't any bad ones, you sell the less good ones. The other thing that's quite interesting, we talked a little bit in here about ESG and about people not following through on their beliefs on climate change, etc., with their consumer performance. And so we looked at EasyJet and Ryanair, etc. They like, and that made me think again about the divestment that I mentioned earlier. How you get there. He said, we don't have very many miners or oil companies. But if you were ESG minded and if you were climate change minded, then you wouldn't want to hold any of these things either, would you? And once you start not holding EasyJet and not holding Ryanair and then not holding anything that creates jet fuel or anything that has a shop in the airport or anything like that, where do you end?
Well, it's the fundamental issue, isn't it? It's kind of like the fund management industry and the ESG side of things is I think this is where even at a more fundamental level, is kind of greenwashing anyway, because an awful lot of the harder core arguments, like no one should fly again, you should never dig anything out of the ground, are essentially anti-capitalist. And you can, that I don't mind if you think that. I think you're stupid if you think that, but it's fine. That's a valid. Kind of, it's your opinion. But at the same time, in that case, you just wouldn't invest in anything at all, because, you're propping up the market, you're propping up the system that you're trying to, unravel or destroy. So I think there's a very fundamental conflict, which is, I guess, coming more to light now anyway. But yeah, so no, I suppose that's the other reason why I think I talk about this stuff at one level. It's both incredibly superficial and kind of pointless in a way, because it's almost like two groups of people completely talking past one another. And the people in the middle who kind of like know they have to save for their pension, but they want their pension to be doing nice stuff in inverted commas because they're somewhat scared of money. It's a whole different. I mean, in fact, that goes back to the psychiatric evaluation. You know, maybe because people get to shed your taboos about money. You know.
Okay, this is going to be quite a long psychiatric session for everybody.
Yeah.
Fund management fees are going to go up massively, and so are wealth management fees. We're all going to have to go shopping to get over it. I loved that he's got Marks & Spencer's in the top 10. You know, as I said to him during our conversation, I don't know how many cycles of Marks & Spencer's is cheap, buy Marks & Spencer's. Oh my God, Marks & Spencer's is awful, sell Marks & Spencer's. I've been through in my quite long career, actually. But I do think that right now Marks & Spencer's does look like they've finally got the hang of this retail thing.
Yeah, actually, I agree. And I feel exactly the same way as you. I had kind of got to the point where I was like, I'm never believing in a Marks & Spencer's turnaround story again. But it does.
And then you went to the food hall.
But I mean, I've still got to say, I still think, why not just spin that off, split them into two things, and then you've got a clothing unit that occasionally performs. And you've got a food unit that is like, you know, a massive challenger, you know, like say Waitrose and all the rest of it. Yeah,
and I don't want them to do that because then they might move the two areas to different sites. And I like to buy knickers and food at the same time. And I think you'll find there's a lot of other people out there who do as well. So it's a non-starter, John. It's a non-starter.
Fair enough.
Anyway, and this, of course, is why I said at the beginning, and I'll say again, this is not just a bull market, it's a British bull market. I know, good, right?
That's good.
Thanks for listening to this week's Merryn Talks Money. We'll be back next week. In the meantime, if you like our show, rate, review, and subscribe wherever you listen to your podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi, additional editing by Moses Andam, and special thanks to John Warren and to John Stepek.